Thank you, Mike.
I've always had the idea that in order to purchase something, it has to be for sale. You had mentioned company buybacks.
Correct.
In other words, a company can buy back their stock regardless of the shareholders wanting to sell or not? How does that work?
No, the shareholders would have to sell the stock. They just go into the market and buy the stock for it. So if there's 100 shares out there and people want to sell their stock, instead of selling your stock to me, the company would come in and just buy it.
Suppose I don't want to sell my stock.
Then you just hold on to your stock.
Yeah, you don't. It's not an individual. You don't have to individually. It's just that these companies come in and offer that, and they offer you the market price for the stock, and then I believe it's taxed at a little bit more of a favorable rate, if I'm not mistaken. So it's up to you, just like Milton said. You don't have to sell it if you don't want to.
The only time there would be a required, so to speak, purchase would be if the company were taking itself private. So if they said we're going to buy back all the stock and take the company private, then you would have a price that they would say that they're going to sell it for. They're going to buy it for, right? And then what they would they take the money, they buy all the shares, and then the shares would no longer be traded. They would now be held by the company, and the company would be a private company at that point. Yes.
That's what happened to Budweiser. Budweiser decided to become private and gave me a offer. This
To
is
take
it.
stock.
You will sell,
Right.
period.
So the was on Budweiser. I think when Budweiser did two things. First, they went private. Then they sold off to ABV. Is it? I think they bought this some international company. I think it's ABV. So yes.
When they buy the stock, these companies buy the stock, good times they buy it, what happens when things slow down or the economy goes down? Do they keep that in stock?
Well, it's the question is about the stock once they buy it back. Once they buy it back, it's what they call treasury stock. So now it's just stock in the company that they could reissue. So down the road, 5 years from now, if they decided they wanted to raise capital, they could reissue 100 shares or 1,000 shares or something like that for it. Other than that, it just becomes a holding of the company. It really doesn't have a value or that for it. I mean, it's not like an asset for them because it's their stock in that for it. It just becomes, instead of there being 1,000 shares in the market, now maybe there's only 500, right? So typically two things would happen in that case. One would be the share price would go up, right? Because instead of having 1,000 shares at $1, now you only have 500 shares. So if it's still going to be worth 1,000, now they're worth $2 a share as opposed to $1 a share, right? Because there's only 500 shares out there for it. And then from a dividend standpoint, if they pay dividends, each shareholder would receive, assuming they pay the same amount per share, you could potentially have a bigger dividend, right? Because they could say, okay, if we're still going to send $1,000 out, instead of sending it to 1,000 people, now we're sending it to 500 people, so now everybody gets $2 as opposed to $1, right? So you could potentially receive a higher dividend that's being paid out for it as well.
Do they get the dividend when they buy those shares back, those stocks back? Do they still give dividends? Does it stay in the company?
No, what happens is, the question is what happens to dividends. At that point in time, it becomes, so there's for a dividend to get paid, there are basically two dates. There's an ex-dividend date, which says you're a shareholder of record by a certain date. So today's March, 7th? So on March 7th, if you're a shareholder of record, we're going to pay dividends on, let's say, April 1st. So you have to be a shareholder here, means you're going to get paid the dividend on April 1st. When they buy back the stock, they're not going to pay themselves back the dividend. It's just, the dividend is for shareholders of record. The corporation isn't a shareholder of record, so to speak, at that point, right? I mean, they have the stock in treasury stock, but it's not really an active stock. They can't use that, the company can't, so to speak, affect the board of directors at that point because they own more shares, right? It's the outstanding shareholders that basically form the directors of that board.
And essentially, the company too is just it's a leading indicator on growth of the company or even the economy, sometimes as a whole. And it's essentially the company betting on themselves, right? They're coming out and saying, you know what, we got a lot of cash on hand, we're in grow mode, we're going to offer a buyback, and you have the option to sell your shares back to them at a nice price, and then, like he said, the book value of the company raises and your stock price will then go up with just a less number of shares or a couple different ways to do it. But it's just essentially the company's betting on themselves and saying, you know what, we're really favorable moving forward and we have a good outlook for the future.
It's almost like a reverse stock split, so to speak. If the reverse stock split says that Instead of the company issuing more shares, they're going to buy back. You're going to get two shares for the one, right? Now, so they're going to buy them back, and instead of having 2 shares, you're only going to have 1 at that point in time. The reason that most companies will do that is to get the value of their stock to increase, and that for it. This situation, the company is just paying. They're just paying market price for whatever the shares are. All right. So it's just another way for the company to essentially prove that they have cash available. Dividends cannot be paid unless there is actually cash available, right? So the company can't declare a dividend if they don't have the cash to pay the dividend and out for it, right? They can't buy stock back if they don't have it therefore. There's a lot being made about stock buybacks, and it's really not as big as what everybody's making it out to be. I mean, it's been going on for a long time. Now is probably not a time that companies want to buy a lot of stock. Why would that be? Stock prices have gone up, right? The time that they would have wanted to buy it back, so to speak, would have been in 2008, right? If they're going to buy back stock, assuming they had cash at that point in time. If the market's up 300 and whatever % and that for it, would I rather buy it now? Would have bought it back in 08, so to speak. So instead of being at $10 a share, maybe back in 08 it was worth $5 a share, pick a number, right? Well, as the company, I could, if I was going to willing to spend 10, I could get 2 for every dollar, so to speak, for every one out there, right? So now I would have preferred to buy it there. The only reason that they're buying back, one of the main reasons they're buying back now, is because they happen to have the cash available for it. So as much as everybody wants to make it think that there's a huge amount of stock buybacks are, while that might be a portion of what's going on with it, it's really not necessarily a good way to deploy capital. Right, so if you've got the money saved up in the company, it's not necessarily the best thing to buy the stock back if I could invest in building a new plant, right? Or I could buy new new equipment that could produce something better, be more efficient on it, buy new computers, buy new cell phones, or whatever it would be for, right? That plant and equipment is more important because that plant and equipment does what? It drives the revenue and it drives the income in that we could potentially see for it, not necessarily just buying the stock back for it. Not saying that they don't incorporate all of it for it, but just focusing on one segment does not necessarily give a true picture of what necessarily corporations are doing with the excess capital. Way back when, in the 80s, when Lee Iacocca was running Chrysler, one of the big things that he wanted at that point in time, and it was unprecedented, is that I believe it was something he wanted to have $10 billion of cash sitting in Chrysler's basically bank account. And the reason for it was that if they had $10 billion of cash, then he would have money available with which to basically make it through another downturn. They could bring out new vehicles, new models, because they had the cash with which to go forward on. Fast forward to today, and you look at a company like Apple, right? So Apple has, I believe, somewhere about $100 billion sitting in cash, right? Just cash, just sitting on the books, right? So what can Apple do with all that money? They could buy back stock, but they're not using it for that. They basically, seems to be what it appears to be, is that they take that $100 billion and they take a portion of it and find a company that they can buy for technology that they don't have to create in-house. So for example, maybe it's, I think they bought a company a few years ago that was fingerprint technology. Right, that they had developed it, and then now they're incorporating fingerprint technology into your phone. So if you buy a new iPhone or that for it, you want to, instead of typing in your passcode or that for it, you use your thumb, I guess, or your finger, and now it reads that and says, okay, we're going to unlock it because you're a portion for it. My phone has retina scanning, where the Microsoft they bought a company that did retina scanning. So basically, I can either type in my code or I can hold it up and it'll scan my face or facial recognition or that for it and say, okay, you're the person that can now open the phone, right? So these companies, when they get a lot of cash, everybody thinks they just sit on the cash. Cash as a corporation really doesn't do anything for the value of the corporation. Yes, it's obviously an asset in that for it, but it doesn't bring the new technology forward. It does just sitting there. It's kind of like a pond, right? If you get a pond that does no activity, after a while, what happens to the pond? Lily pads grow on it, becomes like a dead, it chokes everything out. It's just dead water at that point in time. If you get another pond or another body of water that has a lot of activity on it, there's fishing, there's boating, there's different things, all of a sudden things are getting moved around in that for it. That creates activity that's healthy for the lake in that for it, right? So corporations are using their capital a little bit differently today than maybe what they did in the past, and it's really driving down to where businesses get to. One of the comments earlier was about with regard to to tax rates and that form. So if we rewind back to the 80s when Ronald Reagan was president, he changed both corporate tax rate as well as individual tax rates at that point in time. When he did so, other countries around the world had to react to the U.S. changes, right? And in doing so, they lowered their tax rates because they needed to stay competitive with the U.S. Now, with the U.S. has lowered its tax rates again, what you're going to see around the world is corporations or countries in that lower their tax rates for it. A few years ago, there was a big issue about inversion. You had U.S. companies buying or merging with companies that were in Europe or England or that for it. And the reason is that they could essentially get taxed now at the corporate level at whatever those countries' tax rate were. Now what you're seeing, and you could potentially see a re-inversion, I'll call it, right? Where you could have foreign companies wanting to merge with U.S. companies because U.S. taxes are significantly lower than what they are in other countries, right? There was a big exodus out of France several years ago because France's tax rate was so much higher than England's. And there's only the channel, it's 90 miles, I think, between France and England at that point. So, and they would just basically go over and they'd reincorporate England, and now they'd have a lower tax rate than what they would have in France and that point. So, kind of like what's happening in Illinois, right? Right? I mean, just kind of parallel to what's happened there. Illinois has relatively high taxes in that for it, right? And so, what are a lot of people doing? They're moving to other states. They moved to Indiana, right? There's a couple articles for it that was so in the United States right now there are three states in the U.S. that are losing population. So can anybody guess who number 3 is?
Illinois is.
No, Illinois is not number 3. Number 3 would be, I believe, was New York. All right. Number 2 was New Jersey. And number 1, Illinois, right? So the Illinois, we're at the top of the bottom of a list, right? So what you're seeing is that you have a lot of population leaving, right? So population leaving, and in the article, what it referenced, it said that Illinois has negative population and negative growth for population, all right? So last year there was an article that said basically 2010 and 2017, roughly about 325,000 people had left Chicago, Elgin, Naperville, Rockford, and Peoria, the 5 major cities in Illinois in that point, right? 325,000 on top of the people that left between 2000 and 2010. That's why we had less congressional seats and they redistricted and everything. By the time we get to 2020, it could be that out of the state, we've lost maybe, let's say, another 500,000 people in that point. Well, the big question isn't whether we should raise taxes. The big question is how do we get people to stay in the state? Right. And if you're raising taxes, is that going to want people to move here? I was having a conversation with somebody the other day, and I said, why would someone want to move to Illinois? So if I lived in, pick a state, I lived in Missouri, right? Why would I want to move to Illinois? I got high taxes, right? I got corrupt government. I have a lot of negatives for it. And people want to continue to raise taxes, like, well, why would I want to move here, right? So, and that's the exact opposite of why you're seeing people leave, right? It's like, well, why do I want to stay, right? So, on top of Illinois being number 1 for the people that are leaving, from a sales tax area for it, do you know where Illinois ranks with regard to sales taxes? No, not quite that high, a little bit lower. We're number 7, so we're not the top of the list. We're in the top 10 though. We keep our standing. Right now, the combined tax rate, it says on average is about 8.7%. That's not if you're in Cook County or if you are downtown. So you're aware if you're downtown, basically between McCormick Place and Water Tower and the lake and the expressway, down there the tax rate's 12%. Right. In Cook County, basically it's 10%. So it's all designed, to try and generate the taxes. So when they say that Chicago is one of the most expensive cities in the world, it's because of all of the additional taxes and everything on it. So kind of staying with that theme on it, does anybody know where Illinois ranks with regard to property taxes? So we're still in the top 10. We're still in the top 10. We got to keep that trend going here for it. No, better than that. A little bit better. We're only number 2 on that one, right? So study Illinois number 2 in property tax rate. So so you've got high sales taxes, you've got high property taxes. All of these things are leading to why do people want to move in, and if you continue to say you're going to raise taxes, you're not going to have people necessarily move in. What it also means to people that are here is that we need to have more income potentially to cover those additional expenses, right? How many received their tax bills, right? A lot of people, right? When you received your tax bill, it may have been a little bit higher than what last year's was. And if your income didn't go up accordingly with which to cover that increase in the taxes, where did that money come from? It came from your income, right? So you now had less income to spend, and if they're raising property taxes and they're raising other taxes for it, just to stay plateau, right? You need to have more income coming in with which to cover those particular expenses in that work. Yes?
Speaking of, do you know where Illinois falls in terms of average income in the state?
I had it in here. Median household income is roughly $62,000.
And where we rank?
I've got in another study, I just don't have it with me for it. But it's, as far as ranking on it, we're, I think, in the top 20 for as far as income potential for it. But as my dad told me, it's not what you make, it's what you keep, right? So just because I made it, if I don't get to keep any of it, which in Illinois they seem like they want to take all of it, So so if I can make it, but I don't get to keep it, then did I really make it, so to speak, right? At that point in time. So with those things happening for it, it all becomes something that we need to continue to look at. If we have assets that are not necessarily working very well for us, that we need to put some things that can continue to pay so we can cover the additional expenses. Every time I turn on the television, all I see is hear about politicians saying nobody's paying enough. And they didn't ask me because I think I pay too much, but that's just my personal opinion for it. So,
why did New York turn down Amazon? That's all tax revenue. Why did they turn that down?
It's interesting. I have a conversation with somebody from New York last week. What his comment to me was there were roughly 14,000 people that didn't want Amazon and 14 million that did. Okay. What it further enhances, and I don't know why Amazon chose New York anyway, because to me personally, it's not a very good business climate anyway for it. I'm just finding the reaction to it kind of interesting, because while it would have created jobs, it would have created infrastructure, would have done all these things for it, it was that they were going to get a tax break to basically go in there. Well, in some cases, you have to spend money to make money, so to speak, and you looked at the economic improvement that would have been created through the company going in there was, I think, the number was 10 to 15 times more than what the tax break and that was going to be with. The problem is that you have people that don't know economics and don't deal with businesses and don't have anything other than a selfish interest on it, trying to say what happened there for. I'm not a big fan of Amazon. I think Amazon doesn't make, in my opinion, they don't make any money compared to their relative stock price and that for it. But when you look at a business's main focus of business is not for employees. The main focus of business is to make money, right? Is to enhance shareholder value. By the byproduct of that is, in order for them to make money, they have to do other things and build things and do things to get there for it. Why they didn't want it? I don't know. I think you'll see Amazon will move on. They'll take their $2 billion or whatever it is they were going to invest, and they'll move on. I just find it interesting that Democrats in New York were complaining because Amazon is going to get all this tax break, and therefore when they want to keep taxing people more. What's funny about it was about a month ago, Governor Cuomo was on TV and he was crying because he was blaming the Trump tax cuts on people leaving New York. Because, remember, number 3 was New York, number 2 New Jersey, and Illinois, and that for it, right? And so there was another article that said the biggest recipient of states that are fleeing, Illinois, New York, New Jersey, basically are states like Florida. And Cuomo was complaining that people were moving from a high-tax state of New York to a low-tax state of Florida. And I just said to myself, I said, well, if you're an uncompetitive business, don't you have to do things to improve your business model to make sure that people would want to buy your product, therefore? And if you're in a situation where you're uncompetitive, rather than complaining that somebody has a lower price on it, maybe you need to do something to fix it, right? And so it wasn't addressed that, it was just a complaint. And there was also been an article that said that he's still trying to court Amazon, but I can guarantee you if he's trying to get Amazon back, the $2 billion or whatever that they were anteing up to begin with, that just doubled, right? Because if I'm Amazon, why would I want to come back into a hostile situation unless you really make it worth my while? And $2 billion was maybe worth their while to begin with. That price of poker just went to 4, 5, 6, 8, right? Because at that point in time, I'm going to squeeze every dollar because I know you need it. And what happens when somebody needs something? The price of it goes up, right? It's kind of like you don't want to put yourself in a situation where you have to sell something, because if you have to sell it, what's going to happen? You're not going to get the most value for it because people know that you have to sell, right? And when you have to sell, you're going to get a lower price because you don't have a choice. You have to sell in that fork, right? So just 2 other things with regard to Illinois that you might be interested in. There was an article that talks about the drastic, risky measures to fix America's broken pension system. So this article basically talks about Illinois and Kentucky weighing extreme options to reduce their pensions debt, but they say the critics could ultimately cost the states more with regard to it. So part of the article says during the time span last 10 years, states have gone from about 60% of assets needed to meet liabilities to just 13%. In Kentucky and that for it. In Illinois, the costs are relatively similar in that for it. There's roughly a $3.2 billion budget deficit for just the pension area for it. And Pritzker wants to extend scheduling of payment. He wants to push out the debt payment for it, but that has its own problems. That sort of delay is exactly what Illinois has gotten itself into, and S&P Global Ratings warned this week has been key contributor to Illinois' deteriorating credit position, which is one notch above junk bond status. So if Illinois ever gets declared junk bond status, the cost of all the debt that we're issuing now, if let's say it's, 5% at that point, new debt's going to be, to borrow it, it's going to probably be 8 or 9%, because if you're a bad driver, do you get good driver rates? No, right? If you're a bad driver, you get bad driver rates. If you're a good driver, you should get good driver rates for it, right? Illinois is not necessarily a good driver right now for it, which more says if they are going to continue to have taxes and increase taxes, what in the article basically it looks like for it, then we need to look at maintaining where we're at. Says that we may need to try and earn more income with which to cover the cost of all these other things that they're looking at, right? The one thing it says, comparing Illinois and Kentucky for starters, neither state has paid their full pension benefit for years, which is akin to skipping credit card or mortgage payments and then just letting it continue to build up in that for it, right? So it's not if you miss one credit card payment that it's an issue, right? But if you miss 4 years worth of credit card payments, the interest that's rolled over on that for it could be a problem in that for it. Illinois' obstacles are generally legal and political. Protections for workers, pensions are fierce, and barring a change in the state constitution, which is likely difficult, Illinois would be hard-pressed to find ways to reduce its retirement liabilities. So if it can't reduce its retirement liabilities, they're not going to cut. I heard one politician say they're going to redeploy assets, they're going to cut assets, they're going to cut things. Everything is we need to spend more, we need to spend more, we need to spend more. But no one's ever said where the money's coming from, right? Pritzker's first day in office, he signed the legislation that Rauner opposed, basically paying increasing the wages, the pay increases for state employees in that for it. Average estimated cost was between 125 and 150 million dollars, I think. Still haven't heard where that money is going to come from, with which to pay. Because last time I checked, Illinois doesn't have an extra 125 million dollars just sitting in a kitty or somewhere, right? So where is that money going to come from? Along with the other money that they want to spend. That's just a question of where does it all come from, which if it does mean higher taxes and that for it, well, if it's higher taxes, then that means that it's going to cost more out of income. If it costs more out of income, you have less income, so, so it becomes a debt spiral and that for it. That being said, we have to continue to look at your situation and make sure, from a standpoint, that we've got potentially have additional funds available with which to potentially take care of these increasing costs and that for it, right? One other quick question, one other quick statement here. Demand exceeds supply. 4.1 million Brits were waiting to be admitted to a hospital in England to have a non-urgent surgery as of 9/30/18. You know what England has? Socialized medicine, single payer medicine. So, all right. So 4.1 million people for a non-invasive. So what they considered non-threatening in that for it were cataract surgeries and hip replacement surgery. Those were two considered non. I guess if you're the person that doesn't need hip replacement, it's okay. If you do, it's just okay. This is the highest number of citizens waiting for surgery since August of 2007. So, there's your plug for socialized medicine. So, Medicare has its issues for it. It is a single payer system in that for it, and everybody knows it's out of money in like 2026, right? So, until they figure out how to do that for it, there's no reason why we want to go down that rabbit hole for it. So, one other one, owners and renters. There are 110.7 million households that existed in the United States as of 12/31/08. We're split basically 68 to 32 between 74.7 million owners and 36 million renters. The 122.5 million households in the U.S. as of 12/31/18 were split 65 and 35, meaning 79.4 and 43.1. So a lot of times you'll hear that home ownership is down, when in the reality the numbers are, it's up. On a percentage basis, it's down 4 full percentage points, but the number of people that went from 74.7 to 79.4, the number of households. Last time I checked, that's an increase in the number of households, but on a percentage basis, because the total went up for it, as a percentage of that, it's showing down, right? So, as Mike was talking earlier about the numbers and the details and the data and that for it, percentages are just mathematical calculations, right? If I take one number divided by another, I get a percentage. It may not necessarily tell the whole story of what's actually happening. Just as an example, would you, if you had $10,000 and had earned 5% on it, or would you rather have $100,000 and earn 3% on it? Last time I checked, you didn't take the percentage to the bank. The bank didn't say what's your percentage. The bank wanted dollars, right? So would you rather have $500 or $3,000? I'm assuming $3,000. If you don't need it, you can send it to me. I'll send it. Any questions?
Yeah, one quick question.
Yes. It's never a quick question.
Regarding the feds and the interest rate, I know that they usually raise the rates when they see that the economy is growing too fast. Now, what's an example of them lowering the rate when like it's going into a recession or something?
So the question is, the Federal Reserve, why would they raise rates versus when would they potentially lower rates in that for it? Typically, you raise rates to slow an economy down, right? I guess, in slowing an economy down that's going at 3%, that's like going from 20 miles an hour to like 18, right? I mean, you're not going very fast at that point in time. If the economy were growing at 5, 6, 7, 8%, you'd see the Fed say, okay, we're going to raise rates, and the reason being is they want to slow everything down at that point where the cost of capital becomes more expensive. When they would lower rates would be theoretically when we're actually in the recession or in there for it. They're typically not doing that on a precursor, so it's not like, okay, well, we think that there's gonna be a recession a year from now. It's like, okay, we're in the recession, now we're gonna cut them, right? Which typically is why you see the markets are that over 18 months being down on average, right? Because if it takes, by definition, a recession is 2 consecutive quarters of 0 or negative growth. Well, that's 6 months. So before the Fed, so to speak, says, oh, we're in a recession, by definition, so therefore, you're already 6 months in. So now they're going to take action to theoretically try and change things. So they're going to cut rates theoretically to go that forward. If they do that, you've got another basically 12 months before that actually hits the system. Because just because somebody lowers a rate today doesn't mean tomorrow everybody jumps out and says we're going to take advantage of it, right? Because everybody wants to kind of see where things are going. Are they going to lower again for it? If they do, then if I buy now versus if I wait 6 months, am I going to be in a better situation? And that's what typically you see happen within the economic cycle. You see Fed, they'll cut rates for it, but they've only cut rates once something has happened, right? If we kind of rewind back to 2008 and for it to say, well, when did they start cutting rates? Well, it wasn't until we're actually in 2007, 2008, right? They didn't start, prior to that, they were actually raising rates. Right? So they raised them, the tipping point came over, raised them too much, and then it says, oops, we raised them too much, but it wasn't until after everything had already happened that now they're coming back in to try and correct the deficit. Any other questions? Yes?
Now, I worked at Nabisco, 73rd and 5th,
Okay.
for 40 years, from 1960 to 2000. I've been retired almost 20. But when they wanted their stock back, they didn't give us an option. They gave us 20 cents on the dollar. And when they wanted it back, they bought it all back. We had no choice.
Could have depended on what type of plan it was in. So if it wasn't personally held stock and was part of a corporate plan or that for it, then the corporate plan could have been as part of an ESOP program from the
We didn't
buyback.
have a choice. We had to sell it back.
Depends on how the stock was held. If it was held individually, if you had bought the stock and you had it sitting in your account for it, in a whole separate account for it, they can't just come back in, so to speak, and confiscate the stock. If it's in a like pension program or something like that, that has some different potential rules on it because they essentially gifted the stock at that point in time. You didn't buy the stock. It was a
They gave
gift
us
for it.
20 cents on a dollar, but we had to pay for it. 20 cents on a dollar on each dollar we put into it. But when it was time for them to take it back, they took it back. They paid us good, real good. But still, we didn't have a choice.
I'd have to go back and look and see what transpired at that point in time, that if they were doing stock buyback or if there's some covenant within the stock that's in there. So I'm assuming it was either as part of an ESOP program or part of a 401k program or something for it. If it was, then there could have been some different rules with regard to the stock that was sent to the place. Right, but I don't know what they went through in that for it.
It's too late anyway.
Yeah, I don't know, there had to have been something that was occurring at that point in time to put them in position to do that. I just don't know what it'd be. I'd have to go back and look for it. Any other questions? Well, thank you very much for coming. Try and stay warm in that. And see you next month.
By the way, you were right, that IBC, that's exactly what Budweiser became. InBev.
InBev, yeah, I knew it was something like